Welcome back to the deep dive. Today, we are opening the book on one of the most foundational, yet, conceptually dense areas of corporate governance.
It really is.
We're talking about the requirements governing the accounts of companies. For those of you studying, practicing, or just seeking a really deep insight into the corporate financial backbone, this is your accelerated, expert-led path.
That's right.
We are going to be mastering sections 128 through 138 of the Companies Act.
And we are approaching this as a critical review, not just a recitation of the rules. Our mission here is to move beyond rote memorization.
Which is so easy to fall into with law.
It is. We need to understand the underlying governance principles, the protection mechanisms these rules serve. Why does the law impose these burdens on directors? Fundamentally, these laws exist to ensure two non-negotiable outcomes: verifiable accountability and the guarantee that the financial statements present a true and fair view.
That phrase, verifiable accountability, that's key, isn't it? If you accept the privilege of incorporation, you accept the societal contract of transparency.
Exactly.
So over the next 30 minutes or so, we'll systematically unpack these key sections. We'll focus on the logic behind the mandatory accounting systems, the revolutionary role of digital records, the checks on mismanagement, and, of course, the huge mandate of corporate social responsibility, or CSR.
Let's start right at the very foundation, Section 128.
Perfect.
Section 128 is really the behavioral mandate. It tells a company how to track its financial life and what financial language it must speak. But before we get into the rules, we have to establish the strict terminology the Act uses.
Okay, so what are the key terms that often trip people up?
Well, there are three core definitions. First, you have books of account. These are the primary ledgers, the records capturing the actual transactions.
The day-to-day stuff.
Precisely. Then second, you have a broader category, books and papers. Under Section 212, this includes the books of account, but also deeds, vouchers, documents, minutes, and registers.
So everything.
Pretty much. And the key takeaway for the modern era is that this definition explicitly includes items whether maintained on paper or in electronic form. The law is now format agnostic.
Which brings us to the third term, the financial statement itself.
Correct. Defined in Section 240, this is the summary output. It's the balance sheet, the profit and loss account, or, the income and expenditure account for a nonprofit. It also includes the notes and the cash flow statement.
Although there are some exceptions for the cash flow statement, right?
There are, and they're important. A one-person company, a small company, a dormant company, and certain startup private companies, they do not need to include the cash flow statement.
Got it. So the company knows what it needs to produce. But let's get to the why. Conceptually, why must these records be kept in such minute detail?
The regulatory intent is, well, it's twofold. Firstly, to ensure that true and fair view mandate is met. The records have to reflect reality, not just a convenient story.
And the second reason?
Secondly, transparency has to extend beyond just the headquarters. The records must also reflect and explain transactions at every single branch office. This prevents that classic manipulation technique of, shifting questionable activity to a less scrutinized branch somewhere else.
Right. So if we move from the why to the what specific categories of information is the law demanding, if a company only tracks simple cash in, cash out, what is it missing?
They're missing the core pillars of economic activity. We can actually use a mnemonic to lock down the mandatory content here. It's SAC.
SAC. Okay, I like that. Let's break it down.
The S covers all sales and purchases of goods and services. The A addresses the entire financial structure, the assets and liabilities of the company.
And the C.
And the C is for the cost items, specifically those records prescribed under Section 148, which relates to cost audit requirements. If the books don't comprehensively capture SAC for all locations, they are non-compliant, period.
Now, beyond just the content, there are these rigid rules about how the accounting must be performed. This isn't optional, is it?
Not at all. Section 128 mandates two strict principles for modern corporate reporting.
It's the first one.
The first is that the books must be maintained on the accrual basis. This is fundamental. We record income and expenses when the economic activity happens, when a liability is incurred or revenue is earned, not just when the cash physically moves.
And why is that non-negotiable?
Because relying only on the cash system gives you a severely distorted picture of financial health. It ignores current obligations and receivables. The law is looking for economic reality, not just your bank account balance.
Right. And I see in our source material there's a direct question. Can XYZ Limited maintain its books of account on cash basis? And the answer is just a hard no.
An unequivocal no. The Act demands the accrual method to get to that true and fair view. The second principle is just as vital for integrity, the double entry system of accounting. It's brilliant because it provides inherent control. Every single transaction must have a dual effect, a debit and a credit, and be posted in at least 2 accounts. This system is self-checking. If your debits don't equal your credits, your books don't balance. It's an immediate built-in governance check.
Okay, let's talk about the physical location of these meticulously kept books. The default is the registered office. But what if a company wants some flexibility? We have the scenario here of Hart Ltd. Wanting to move its books to a corporate hub like Mumbai.
That flexibility is granted, but with a strict procedural safeguard. The alternate location must be any other place in India, as decided by the board of directors.
But there's a catch.
There is. The company must file a notice with the registrar, the Row E, giving the full address of that new location within a very tight window. 7 days of the board's decision. Missing that 7-day window makes the company non-compliant.
That short timeline really emphasizes the seriousness of regulatory notification, and I assume access remains critical. Any director needs to be able to see the books.
Absolutely. They must be available for inspection by any director during business hours at whatever location has been chosen. Finally, consider preservation. The books and the related vouchers have to be preserved for not less than 8 years, immediately preceding the relevant financial year.
8 years?
And if the company is younger, they must preserve them for its entire period of existence. This preservation rule really lays the groundwork for accountability, especially when regulators come knocking years later under Section 130.
The shift from paper ledgers to electronic records is obviously efficient, but as you mentioned, it brings huge risks. Data integrity, unauthorized changes, security. So Section 128 tackles this head-on with specific rules for records in electronic mode.
It does. The first critical point is about, let's call it, geographical sovereignty and accessibility. Regardless of where a company's servers are, the records must remain accessible in India at all times, so they can be immediately accessed for any inspection.
And integrity is ensured by the format rule, right? They have to be kept in the original format.
Exactly. Or an accurate, unaltered format. Rule 3 even stops any games at the branch level. Information from branches must be recorded exactly as it was originally received, with no alteration.
This brings us to a really significant technological update, especially for anyone in IT compliance. For financial years starting on or after April 1st, 2023, the law imposed a new 3-part mandate for accounting software.
This is where the Act really crosses into technological governance.
So what are these 3 non-negotiables that the software must have now?
First, the software must record a full audit trail for every single transaction. Second, it has to create an edit log for every change made to the books, with the exact date of that change.
And the third part is the real kicker.
It is. The third most critical part is that the software must ensure this audit trail cannot be disabled.
Wow, that is a fundamental game changer. It shifts the burden of proof entirely. If you can no longer hide or disable the log of changes, how does that redefine something like fraud in a future court case?
It makes fraudulent intent much, much harder to conceal. Before, proving a fraudulent change might have relied on forensic analysis or testimony. Now, the log itself is a primary, potentially irrefutable piece of evidence. If the log shows an edit 6 months after the fact, that's it. It's recorded. Backdating becomes almost impossible to hide.
It's the future of accountability just written directly into the statute.
It really is.
Now let's talk about the global footprint. Many companies use international cloud providers. If the main server is outside India, what's the backup rule?
Even if the main server is, say, in the US or Europe, the law is uncompromising. The backup of the books and papers must be kept in servers physically located in India on a daily basis.
On a daily basis.
Daily. This ensures that, regardless of international data disputes or server failures, India maintains a complete, up-to-date copy of its corporate financial data within its jurisdiction. It's a data sovereignty issue.
What about synthesizing all this data from foreign and Indian branches? Do they have to send the full daily ledger back to HQ?
No, the full ledger isn't required, but strict communication is. The branch has to keep its own proper books and then send proper summarized returns to the registered office at mandated quarterly intervals. This gives the head office continuous, consolidated visibility.
Okay, so that's Section 128. Let's move to Section 129, which shifts our focus from the raw data in the books to the final presentation in the statements.
Exactly. And it reinforces that core mandate we keep coming back to. Financial statements must comply with the prescribed accounting standards, that's AS or IND AS, and give a true and fair view.
Compliance with those standards, governed by Schedule 3, is what gives us uniformity and comparability, right?
It is. Without it, you couldn't reliably compare Company A to Company B. Schedule 3 sets out the detailed formats, whether a company follows the simpler AS or the more complex IND AS.
For a simple company, a standalone statement is enough. But what about these huge, complex corporate structures with subsidiaries and joint ventures? That's where the Consolidated Financial Statement, or CFS, becomes mandatory.
This is a critical regulatory response to financial engineering. Before consolidation, companies could hide debt or underperforming assets on a subsidiary's balance sheet.
Keep it off the main books.
Precisely.
hmm
So the law now says if a company have one or more subsidiaries, associates, or joint ventures, it must prepare a CFS in addition to its standalone statements. The CFS treats the entire group as a single economic entity.
So the goal is to stop a company from looking strong while its economic family is actually weak.
Exactly. It paints the complete, unvarnished financial picture. However, the law does provide some key exemptions from preparing a CFS, which are important to avoid redundant filings.
Right. If a company is already nested inside a structure where that consolidated picture is public, they might be exempt. What are the conditions for that exemption?
And remember, all three conditions must be met. First, the company has to be either a wholly owned subsidiary or a partially owned one where all the other members have agreed in writing not to have a CFS.
Okay, that's condition 1.
Second, the company's securities must not be listed or in the process of listing anywhere. And third, its ultimate or any intermediate holding company must file compliant consolidated statements with the registrar.
So if the big picture is already publicly available further up the chain, the subsidiary doesn't need to duplicate the work.
That's the logic. It makes perfect regulatory sense.
Good. So we've established how things should be done perfectly. But what happens when they're not? That brings us to sections 130 and 131, which are about fixing the books.
Yes, two fundamentally different paths. Compulsory correction by the state and voluntary correction by the company itself.
Let's start with the big one, Section 130, compulsory reopening. Why would the law allow accounts that have been finalized and audited to be forcibly unwound?
It's the legislative nuclear option. It exists because maintaining public trust requires that financial history reflects reality, even if that means correcting years of accepted records because of, well, fraud or deep-seated manipulation.
This can't be initiated by just anyone, though. It requires an application from specified authorities and an order from a court or tribunal. The grounds are very strict.
Extremely strict.
Yeah.
The tribunal's order has to be based on convincing evidence of one of two things. Either the accounts were prepared in a fraudulent manner, or the company's affairs were mismanaged during that period, which casts doubt on the reliability of the statements.
So who has the power to apply for this? Who are these specified authorities?
Here's another mnemonic to remember the list. CISSP.
CISSP.
C is for the central government, I is for the income tax authorities,
Yeah.
S is for SEBI. The second S is any other statutory regulatory body, and the P is any person concerned, as long as they have a strong, demonstrable interest.
Once one of the CISSP authorities applies, the tribunal doesn't just act on its own, does it?
No, it has to issue a notice and get representations from the central government, the income tax authorities, and, critically, the original auditor who signed off on those statements before it can pass a reopening order.
And what about the time limit, the limitation period? Can the tribunal force a company, let's say Cheaton Ltd., to reopen books from 15 years ago?
Absolutely not. The law provides a hard boundary here. Reopening is generally limited to 8 financial years immediately preceding the current financial year. So, using the example, if the current year is 2023-24, the tribunal can only reach back to 2015-16. Any irregularities from, say, 2012-13 are legally beyond the statute of limitations for this section.
Which provides some degree of finality.
It does.
Okay, now let's look at the flip side. Section 131, voluntary revision. This isn't about fraud. It's about acknowledging an error. Why allow directors to revise accounts after they've been filed?
It's a proactive governance tool. It lets management maintain investor confidence by correcting a known issue-like noncompliance with Section 129 or 134 without waiting for the regulatory sword to drop under Section 130. It's basically corporate self-cleaning.
But there must be some statutory handcuffs on this. Directors can't just rewrite history whenever they want.
No, the control is very strict. First, the directors have to apply to the tribunal within a very short window, 14 days of the board's decision to revise. Second, the revision is limited to a narrow scope. Only any of the 3 preceding financial years. You can't go back 8 years like the regulators can.
And what about how often they can do this?
That's the most critical constraint. A revision can only be done once in a financial year.
Right.
If they mess up the correction, they have to wait until the next year to try again. And the revision has to be strictly confined to correcting that specific noncompliance.
And again, the tribunal acts as a checkpoint, even for this voluntary action.
Yes, the tribunal still has to issue notice to the central government and the income tax authorities. They consider those representations to make sure a company isn't using Section 131 as some kind of loophole. Once it's approved, the revised statements have to be filed with the registrar.
So the quality of these financial statements depends entirely on the rules they follow and the strength of the body overseeing compliance. This brings us to the institutional framework, the regulator, and the standards.
And we have to formally introduce the National Financial Reporting Authority, or NFRA, which was constituted on October 1st, 2018.
What conceptual gap was the NFRA designed to fill?
Before NFRA, oversight of auditors was largely left to professional bodies like the ICAI. There was a need for an independent, powerful statutory regulator to provide high-quality oversight of both accounting and auditing, specifically to protect the public interest, investors, and creditors.
Let's look at its composition, which is designed to enforce this independence.
The NFRA consists of a chairperson who must have proven expertise in accountancy, auditing, finance, or law, and up to 15 other members. And crucially, everyone has to make a declaration of no conflict of interest or lack of independence.
And that independence rule is pretty severe for full-time members, isn't it?
It is. If you're a full-time member, you can't be associated with any audit firm during your appointment, and for a strict cooling-off period of 2 years after you leave. This structural independence is vital for their credibility.
Now, let's talk about NFRA's investigative authority, the teeth of the regulator.
NFRA has the decisive authority to investigate professional or other misconduct by chartered accountants or CA firms. This can be initiated suo on their own or on a reference from the central government.
And the critical legal implication here is its supremacy.
Yes. Once NFRA initiates an investigation, no other institute like the ICAI can start or continue any parallel proceedings on that matter. NFRA becomes the sole jurisdiction. It centralizes authority.
What tools do they have during an investigation?
They have quasi-judicial powers. They have the same powers as a civil court. This isn't just a desk review. They can compel the production of documents, summon people and examine them on oath, and physically inspect records.
And if misconduct is proven, the penalties are designed to be a serious deterrent.
They are. For individuals, the fine can go up to 5 times the fees charged. But more importantly, NFRA can impose debarment from practice for a significant period, from 6 months up to 10 years.
Which could be a career ender.
It could. And for firms, the financial penalties are even higher.
So NFRA's other major function under Section 133 is ensuring everyone plays by the same rule-setting, uniform accounting standards.
Yes, and this collaborative process is essential. Without uniform standards, financial statements would be useless for comparison.
So who actually sets the standard? Is it just one body?
It's a powerful 3-stage consultative filter. The central government is the ultimate authority that prescribes the standards. However, they only act on the recommendation of the ICAI. But, and this is the key, that recommendation must first be made in consultation with and after examination by the NFRA.
So NFRA is the critical gatekeeper.
Exactly. It ensures the standards proposed by the professional body meet the stringent, independent regulatory needs of the government.
Okay. We've established the books and the standards. Now we move to the moment of public reckoning, the board taking explicit ownership of the financial results. Section 134.
This is the formal link between the director's duties and the public documents. Before any financial statement can be issued, it has to be approved by the board and properly signed. And the law is very specific about who signs.
Let's run through the signature requirements.
There are 2 main options for directors. Option 1, the chairperson, if the board authorizes them. Option 2, 2 directors. But with a critical condition, one of those 2 must be a managing director, if the company has one.
And it's not just directors. Certain key managerial personnel, KMPs, also have to sign.
Absolutely. The CEO, the CFO, and the company secretary, if appointed, must also sign. This ensures the operational and compliance leadership, not just the board, are certifying the statements.
So let's apply this to that Vishwakarma Electronics scenario. They have an MD, 2 other directors, and a company secretary. 2 non-MD directors sign the statements. Is this compliant?
It's a clear failure to comply. Since they have a managing director, he must be one of the 2 signing directors. And since they have a company secretary, the CS must also sign. This example just underscores how strict that signature hierarchy is. You can't substitute people.
So if the financial statement is the what, the board's report is the why. It's the narrative document where management provides context and explains performance.
It converts raw numbers into an accountable story for the shareholders.
Given how long this report can be, let's just focus on the key governance components that the Act mandates must be in there.
Okay. Starting with administrative transparency, the report has to disclose the web address where the company's annual return is placed. It must include the Director's Responsibility Statement, or DRS, as a mandatory attachment.
What about issues that auditors found but maybe didn't escalate to the government?
The report must detail frauds reported by auditors that were not reportable to the central government. This ensures transparency about internal control failures. It also requires extensive cross-referencing, particulars of loans under Section 186, and details of related party transactions under Section 188.
So it forces the board to justify transactions that could be a conflict of interest.
It does, and there's a heavy emphasis on forward-looking governance and risk mitigation.
How so?
Two key mandates here. First, detailing the development and implementation of a risk management policy. And second, a disclosure on the adequacy of internal financial controls, or IFC, with reference to the financial statements. This reveals how robust the system that generated the numbers actually is.
Okay, so that brings us to the Director's Responsibility Statement, the DRS itself. This is the central certification of diligence, right?
It is. It's where the directors put their name on the line. It must contain 6 specific declarations.
Let's maybe group these into 3 conceptual pillars to make it easier to remember.
Good idea. Pillar 1. Accounting quality. The directors certify 2 things here. First, that the applicable accounting standards were followed. And second, that accounting policies were selected and applied consistently to give a true and fair view.
So that covers the correctness of the numbers. What's pillar 2?
Internal controls. This is about structural integrity. The directors must state they laid down internal financial controls. And critically, they must also certify that those IFC systems were both adequate in their design and operating effectively.
And pillar 3?
Legal compliance. The final declarations certify that proper systems were in place to ensure compliance with all applicable laws, and that those systems were also adequate and operating effectively.
Before we move on, let's quickly define internal financial controls, IFC. We see that term everywhere now.
IFC is a comprehensive term. It means the policies and procedures adopted by the company to ensure the orderly and efficient conduct of its business. It covers everything from safeguarding assets and preventing fraud to ensuring the accuracy of accounting records and ultimately preparing reliable financial information.
It's the systemic backbone.
It is.
Now let's revisit that critical MFL scenario.
Yeah.
MFL is a listed company. A major failure in their control system happens in May, but it's fixed by July. Can the directors still certify in the DRS that the controls were adequate and operating efficiently for the entire year?
This is a classic exam question. The law implies effectiveness throughout the year. Adequacy is about design. Effectiveness is about execution. If a significant control failure occurred, the controls were, by definition, not operating effectively for the entire financial year.
So they can't make that statement.
They cannot truthfully provide that certification. That momentary lapse negates the full year statement, forcing the directors and the auditor to qualify their statement, explaining what happened. It shows how serious this is.
Now for a major shift. From internal finance to external mandate, the company's role in society. Section 135, Corporate Social Responsibility, CSR.
And this is more than just charity. It's a legal recognition that corporations use societal and environmental resources, and this section forces a mandatory contribution back to the wider stakeholder base.
For the learner, the first step is knowing if the mandate even applies. What are the financial thresholds that trigger the CSR committee requirement?
There's a mnemonic for this trigger test. 500 NW, 1000 T, 5 NP. A company needs a CSR committee if it meets any of these criteria in the immediately preceding financial year.
Okay, let's break that down.
500 NW is a net worth of rupees 500 crore or more. 1000 T is a turnover of rupees 1000 crore or more. And 5 MP is a net profit of rupees 5 crore or more.
So just meeting one of those triggers it.
Just one. Now,
Yeah.
the committee is usually 3 or more directors, with at least 1 independent director. But there's a key exception. If the mandatory CSR spending amount is 50 lakh or less, you don't need a formal committee. The board can just handle its functions directly.
Which streamlines things for smaller qualifying companies. So once the mandate applies, what's the minimum spending formula?
The company has to spend at least 2% of the average net profits made during the 3 immediately preceding financial years. If the company is younger, you just use the average of the years it is completed.
Let's use that MFL example again. Incorporated in 2020. Profits for the first 2 years were 20 crore and 38 crore. What's the minimum spend for the third year?
You average the 2 preceding years. 20 crore plus 38 crore divided by 2 is 29 crore. 2% of 29 crore is 58 lakh. That's the minimum mandatory CSR spend for MFL.
Now, this is crucial for compliance. What doesn't count as CSR? This is where companies can stumble.
The list of exclusions is vital. Activities in the normal course of business don't count. Activities outside India are excluded, with a narrow exception for training Indian sports personnel, and contributions to a political party are explicitly disallowed.
What about the common issue of employee benefits?
Activities benefiting the company's own employees do not count. The benefit has to be for the wider community, not a disguised HR expense. Also, spending on sponsorships for marketing benefits is excluded. If it looks like advertising, it's not CSR.
There's also a cap on bureaucracy.
Yes. Administrative overheads cannot exceed 5% of the total CSR expenditure for the year. This ensures most of the money actually reaches the beneficiaries.
Let's quickly define an ongoing project, because that term dictates how unspent money is handled.
An ongoing project is a multi-year project, not exceeding 3 years, excluding the start year. If it generates a surplus, that surplus is legally not business profit. It has to be plowed back into the project or transferred to the unspent CSR account.
What if a company gets enthusiastic and spends more than the required 2%?
That excess spending can be carried forward and set off against the requirement for up to the next 3 financial years. It needs a board resolution, but it incentivizes proactive social investment.
Okay, this is where the law becomes an absolute compliance mechanism, handling unspent funds. It all depends on whether it's for an ongoing project or not.
Let's start with money for an ongoing project. If it's unspent at year-end, it has to be transferred to a special account, the Unspent Corporate Social Responsibility account, within 30 days from the end of the financial year.
And once it's in that account, how long do they have to use it?
They have 3 financial years from the date of that transfer to spend it. If it's still unspent after 3 years, the clock runs out. It must then be transferred to a fund and scheduled the 7th within 30 days.
What about unspent funds for projects that are not ongoing?
For those, there's no 3-year grace period and no unspent CSR account. The money must be transferred directly to a Schedule the 7 fund within 6 months of the end of the financial year.
And the penalties for failing to do this are significant.
They're designed to be painful. For the company, the penalty is twice the required transfer amount, or 1 crore, whichever is less. For the officer in default, it's 1/10 of the required transfer amount, or 2 lakh, whichever is less. The message is clear. Budgeting the funds isn't enough. You have to execute.
Okay, we've tracked the life cycle of the accounts, now the final stages. Communicating them to shareholders and filing with the regulator. Section 136, circulation.
Right. What has to be sent? The full financial statements, including the CFS, the auditor's report, the board's report, all of it.
To whom?
To every member, every debenture trustee, and anyone else entitled to get them. And the delivery window is critical, at least 21 days before the AGM.
For large listed companies, sending out huge paper packages is a lot. Is there a simpler way?
Yes, for listed companies. They can comply by just sending a statement with the salient features of the documents. But this is only okay if the full documents are available for inspection and the shareholder hasn't specifically requested the full set.
Okay, that brings us to Section 137, filing with the registrar, the ROCE. Once accounts are adopted at the AGM, what's the deadline?
The adopted accounts must be filed within 30 days of the AGM.
This brings us to a crucial timing trap for companies that can't adopt their accounts right away. Let's use the Sun Ltd scenario. Their AGM was August 31st, but they didn't adopt the accounts until the adjourned AGM on October 15th.
This failure to adopt triggers 2 mandatory filings. If the statements are not adopted at the AGM, the unadopted statements must still be filed with the registrar within 30 days of that original AGM date.
So Sun Ltd had to file a provisional statement by September 30th.
Exactly, and the ROCE records it as provisional. Then, once the accounts are adopted at the adjourned AGM, the final adopted statements must be filed again within 30 days of that new date. A company can meet the final deadline, but still get penalized for missing the initial provisional filing.
We have to talk about the XBRL filing requirement. Why is this structured data format so important?
XBRL is crucial because it makes data machine readable, so regulatory analysis and public comparison is way more efficient. It's mandatory for large companies, listed ones, or those above certain capital or turnover thresholds.
Now let's discuss the critical rule change here, the once-always rule. This is a big compliance trap.
It is a major test point. Once a company crosses the threshold and starts reporting an XBRL, it must continue to file an XBRL in all future years, even if it drops back below the threshold.
Let's use that Amazon Company Limited case. In 1 year, their turnover was 150 crore, mandating XBRL. The next year, it dropped to 90 crore, below the threshold.
Despite falling below the threshold, the company must continue to file an XBRL. The moment you're caught by the net, you stay in the net. The compliance cost becomes fixed, regardless of a temporary revenue dip.
Okay, our final section. Section 138, internal audit. We already have external statutory auditors. Why is a separate mandatory internal audit required for some companies?
The internal audit provides a robust, continuous internal check. It's for the board and the audit committee. Its purpose is different from the statutory auditors. It's about ensuring operations run efficiently, adhere to policy, and safeguard assets. It's risk management from the inside.
Listed companies always need one, but what are the thresholds for unlisted public and private companies?
For unlisted public companies, they need an internal auditor if they meet any of 4 criteria: paid-up share capital of 50 crore or more, turnover of 200 crore or more, outstanding loans over 100 crore, or outstanding deposits of 25 crore or more.
And for private companies?
The criteria are narrower. It's just 2 of them: turnover of 200 crore or more, or outstanding loans over 100 crore.
So who can be an internal auditor?
It could be a chartered accountant, a cost accountant, and they could be practicing or not, or another professional as decided by the board.
This flexibility leads to our final scenario. Perfect Ltd, a listed company, decides to move from an external firm to an in-house internal audit system. Is that okay?
Yes, absolutely. The Act allows for this flexibility. The audit committee or the board determines the scope and methodology. Whether it's outsourced or in-house, the key is that the mechanism exists and is adequate for the company's size and complexity.
Okay, let's wrap this up.
So if we conclude our deep dive into sections 128 through 138, the central theme is this unbreakable chain of accountability. It starts with the integrity of the books of account under 128, demanding a true and fair view under 129. We establish corrective mechanisms like compulsory reopening and voluntary revision. Then we put in place the powerful NFRA, made sure the board signs off on the truth via the DRS, and finally, mandated the company's societal duty through CSR.
I think the core governance takeaway, especially for anyone studying this, is that the framework is designed not to punish simple mistakes, but to enforce transparency and diligence. The seriousness is evident everywhere, in the CSR penalties, the tight filing deadlines, and that permanent XBRL rule. Understanding the why of the law helps you spot these compliance traps.
And to leave you with a final thought to explore, we discussed that new technological mandate from April 1st, 2023, requiring accounting software to have an audit trail and an edit log that cannot be disabled. This fundamentally alters the evidence available. If hidden edits become impossible, the burden of proof in a fraud case under Section 130 might shift from proving who did it to simply proving that a manipulation occurred outside an accepted window.
That's a crucial point.
So consider how this convergence of corporate law and mandated cybersecurity will define fraud investigations in the next decade.
Technology is now writing the compliance rules. Food for thought indeed. That's all for this deep dive. We hope this review has given you a solid conceptual and practical foundation. We'll see you next time.